Well, listen, thanks so much for having me. Thanks so much for joining today. Maybe a brief introduction. I'm originally Dutch. I grew up in Europe. I graduated from college in the US 10 years ago. Started my career at Goldman Sachs. After Goldman Sachs, I worked at Vitol, and for the past 6 years, I've been investing in frontier emerging markets, spending a lot of time in Bangladesh until COVID hit. I actually haven't been back to Bangladesh since COVID, but pre-COVID, I used to go to Dhaka every 3 to 6 months, so I know the market pretty well. I spent a lot of time investing in public companies in Bangladesh before. And about 3 months ago, we launched the first active thematic ETF in the world focused on emerging markets called the Asian Growth Cubs ETF, focused specifically on 5 countries, which you see listed here in front of you. So maybe just take a step back. So how do we get to these 5 countries? So the role of frontier emerging markets is being driven by indices. And if you look at what those indices classify, I would say there's not necessarily a consistent classification between emerging and frontier, but this gives you a high-level view of like how the indices look at the frontier versus emerging world. If you look at what does frontier emerging markets represent, ultimately these are markets that are driven by strong demographics, strong growth outlook, young populations, increasing digital adoption, but also low to no foreign ownership. And the opportunity we leave in these markets is owning high-quality businesses at reasonable valuations before foreigners return to these markets. What you've seen over the last 5 to 10 years, you've seen foreigners basically leave these markets instead of going to the more developed emerging markets, such as Brazil, Russia, India, China. But what you've seen happen in the last year is that investors are once again looking to diversify the EM exposure, which leaves them back to less mature, more emerging parts of the emerging market complex. This kind of gives you an idea of what the population split in 2035 may look like according to World Bank between emerging versus developed markets, which kind of underscores the opportunity which we're looking at, especially in countries like Bangladesh. This kind of gives you an idea of, again, going back to the previous point about the rise of emerging markets. I think you see that on the demographic side, but also that translates onto the economic side. I think interestingly, if you look at this table, you see that in 2016, there were 5 emerging markets that were part of the top 10 economies in the world. By 2030, they expect to be 8. So specifically, you may ask yourself, how do you get exposure to emerging and frontier markets? And historically, emerging market investing has been driven by emerging market indices. But if you look at these indices, what they are, they're actually highly concentrated on 5 countries. And the 5 countries they're highly concentrated on, in many ways, are actually late-stage emerging markets. Some people would call them mature emerging markets. So to take them in turn, you have China, which is almost half the index. You have Korea and Taiwan. Korea and Taiwan have a GDP per capita that's higher than Italy, Spain, or Portugal. Yet they're still an emerging market index. I think you can make a credible argument that you should probably upgrade it to the MSCI World Index, or the MSCI EM Index. And lastly, India and China. Now, to take a step back, when you think about the construction of the indices, obviously one of the people, there's all different kind of views on what should be in an index or not. But the approach the indexes take is they basically put the whole world into one product. And that was a product, thought process that kind of stemmed from the early 2000s in the first stage of globalization, when the BRICS were invented in 2005 specifically. But the originator of the BRICS, which is Jim O'Neill at the time of Goldman Sachs, he's written quite publicly about the fact that if he were to reinvent the BRICS in 2021, he wouldn't call it the BRICS, he'd call it the IX. And the reason why I call it the IX is that India and China are fundamentally different to Brazil and Russia. They're different in terms of their growth drivers, growth history, but also growth outlook. And I think this one-size-fits-all approach, which was the approach that was taken in the early 2000s, isn't necessarily the way investors or returns are dictated going forward. What's interesting is if you look what's actually in the index historically, there's a technology component, which is heavily weighted to Asia. But outside of that, you also see a significant number of companies which are state-owned enterprises. And unfortunately, state-owned enterprises are not always run for shareholders, they're often run for governments. And that's also, unfortunately, showed up in the returns you've seen in some of these state-owned enterprises. This little table here gives you an indication of what were the 5 large positions in the MSCI EM index in 2010, and how do they perform in the 11 years since. And what you see is that the 2 privatized entities actually perform relatively well, but the state-owned enterprises actually perform very poorly. Now, there's been some discussion around your ex-China indices, or basically moving on from China, moving on from Korea or Taiwan in this index. But what the reality is that if you look at what the ex-China index includes, the interesting thing is it actually still includes China exposure. Because what's happened is that they basically removed China, but they've added South Africa. And if you then take one step further and you look at what's in the South Africa exposure, it's a company called Naspers. And you may be familiar with Naspers. Naspers is the largest company, listed company in Africa, largest listed company obviously in South Africa. And they are the large outside shareholder in Tencent, partly through their stake in their subsidiary Prosus, which is listed in Europe. So the bottom line is the ex-China indices, I think, have 2 problems. One, they still remain highly concentrated. So 75% of the index is on 5 countries. And 2, Tencent or China, there's still China exposure in the ex-China index, which is something that I think not many people pick up on. So the question then is, where does Bangladesh fit into this? And I think the reality is that, Bangladesh, unfortunately, is not even in the EM index. It's in the FM index, Frontier Markets Index. If you look at the Frontier Markets Index today, it includes countries such as Iceland, Kuwait, Bahrain, Bangladesh. I think, frankly, the constitution and the composition of the index is broken. So the reality, you're not going to get good Bangladesh exposure through any other existing ETF products. And that's why we are the first ETF product in the world that is once again focused on Bangladesh. That was the product we launched in June called the Asian Growth Cubs ETF. So what does it mean specifically? If you look at 2021, I think there's several milestones for Bangladesh to celebrate. I think the most important milestone obviously is 50 years of independence. I think the second milestone is that the economy still continues to grow very well, despite a global economy that is recovering, but frankly, obviously still crippled by the aftermath of COVID or the ongoing effects of COVID. But I think what's also exciting is that actually, once again, Bangladesh is on the ETF map. Sadly, the last ETF that focused on Bangladesh, which was the DWS ETF, closed in 2020. And we are the first and only ETF in the world that once again provides core exposure to Bangladesh. The ETF we've listed is launched in New York Stock Exchange. It's the first active thematic ETF in the world. So the school we're basically looking to build off of or to learn from is the Cathie Wood School. Cathie Wood's obviously pioneered active thematic ETFs through ARK. No one's ever tried it in EM before. We're doing it in EM. And part of the reason why we're doing EM is that we believe you need an active approach in emerging markets to buy the right companies. What we like to think we're focused on is not the economy of yesterday, which in many countries is tobacco, cement, steel, telco, and banks. What we're increasingly focused on is healthcare, technology, media, and telecom, digital banking, and FMCG. So if you then look at what's also in the portfolio of the companies we have in Bangladesh, we primarily have a high concentration of pharma companies, and then the remainder is in FMCG, financials, telco, and utilities. But when I talk about financials, I'm talking about BRAC Bank. And as you're probably pretty familiar with, that BRAC Bank obviously has a brick and mortar bank, but it also is one of the large shareholders in Bcash, which is a large digital banking business in Bangladesh. So the focus is on capturing the next generation of countries and the next generation of industries, and therefore also next generation of companies. And what's encouraging, I think, about Bangladesh is that Bangladesh historically has been a country that I think has been slightly overshadowed for reasons that are perhaps something to do with whether it's legacy 40, 50 years ago. But I think people increasingly realize that Bangladesh is turning a corner, and the corner Bangladesh is turning makes it much more investable, much more exciting place for people to put money to work. And that's why Bangladesh, I think, as recently as this year, July, was actually referred to as one of the upcoming Asian tigers. Now, I think the existing story of the Asian tigers is very well understood and known, the story of the 80s and 90s, covering Hong Kong, Singapore, Taiwan, Korea. The reason why I call it the Asian Growth Cubs ETF, we're focused on the next generation of tigers, tiger cubs. If you look just specifically before we go into the actual ETF, where can you buy this ETF? You can buy it on different platforms. You can buy it in different private banks. It's very accessible. You can essentially trade it like a stock. So it's very liquid. It's very accessible. And frankly, it's easy to access. If you look what's in the ETF, so the Bangladesh component of the ETF is roughly 17%. And why 17%? Well, basically that's the composition of the countries we have, the companies we have from Bangladesh in the portfolio. The portfolio overall is heavily weighted to what I would argue is the economy of tomorrow. So the large weightings are TMT, FMCG, healthcare, pharma, and ultimately financials. So where does this leave us? I'd like to talk today a bit about the Asian Growth Cubs ETF, not just about Bangladesh. Bangladesh is obviously an integral part of the ETF, but frankly, there's a number of other countries that are in the ETF. And if you look at what kind of characterizes these group of countries that we put together, is they're large countries, they're liquid stock markets, they're fast growing economically, they're untapped, and untapped in this case means there's low to no foreign shareholding, and ultimately these are young, digitally enabled economies that the confluence of these different factors leads to an interesting and promising growth outlook. So specifically, what are these 5 countries? These 5 countries are combined have 860 million people and are 35% larger than LATAM by virtue of population. If you look at the fundamentals of some of these countries, just to start with the size of the 5 countries we're focused on, we're talking about 5 countries that collectively have a GDP that's almost as big as India, but have a market cap that's only 50% of India. And I think what this underscores is that the lack of foreign and even domestic participation in these markets suggests that there's, I think, a material valuation discount in some of these markets, but there's also just frankly low foreign participation in these markets. If you look at the affordability of these markets, and specifically, for example, Bangladesh, Bangladesh GDP per capita has overtaken India GDP per capita for the first time ever in 2020. I think maybe to backtrack a point we'll get to in a minute, Bangladesh, I think, is continuing to show a long-term success story in growing its economy consistently throughout 2020, throughout 2008, and throughout 1998. 3 difficult years for the region. If you look at it specifically, this underscores the relative affordability of the Cubs being the 5 countries which are focused on, which we believe are the next generation of emerging markets in Asia beyond India and China, which have low to no index exposure, but an integral part of any forward-going EM portfolio. If you look at the transformation of Bangladesh, this is something I referred to briefly before. I think Bangladesh has kind of gone from a story of misery to increasingly a story of opportunity. And I think this kind of is captured also in what you see in the news. I think there's this is an article from 2000 on the left, and I think an article on the right as recently as June of this year. If you look at the Cubs as a product, if you look at how has the Cubs done over the last 21 years, what's interesting is that if you were to basically look at the country indices in these countries, so the Dhaka Stock Exchange, the Karachi Stock Exchange, the Jakarta, the Manila, and the Ho Chi Minh, you actually see that the returns from Cubs applying the principles of this ETF, which is semi-annual rebasing, equal weighting, actually would have performed better than not only the India and China indices, but also than the MSCI indices, but also than the S&P 500 indices. And I think what this underscores is the opportunity and the promising capital markets you see in the Cubs, yet they're relatively overlooked / ignored nature. This is dollar for dollar returns, including taxes, including dividends, but doesn't cover taxes, spreads, or fees. I think if you look at what's behind that stock market performance, I think what you see, the starting foundation is robust demographics, but also robust economic growth. If you look at the historical, but also forward-looking growth for the region, specifically for the Asian Growth Cubs, what you see is that it's, again, historically, it was the fastest growing region for the last 10 years. It's expected for the next 6 years, again, to be the fastest growing region in the world. Faster growing than emerging Asia ex-China and faster growing than general emerging markets. So I think the key point to make is that the Cubs are an integral part of any EM portfolio, but you don't actually get access to them through the index. We can get to that point later, but their access composition is roughly 2%. Ironically, the ex-China index has more exposure to China than it does to have to Cubs. If you think about specifically what characterizes these 5 countries I'm focused on, it's a combination of growth. It's a combination that this ETF is the only way to access these countries and these indices. So basically, some countries basically have no ETF exposure. For example, Bangladesh. Other countries do have existing ETFs. 1 ETF in the case of Vietnam, 2 in the case of Indonesia, 1 in Pakistan, 1 in the Philippines. But if you look at what's in these ETFs, it's primarily dominated again by what I call the legacy industries. So cement, steel, tobacco, banking. My view is in these economies, which are characterized by young, educated, digitally enabled populations, we want to focus on the industries of tomorrow, which going back to my earlier comment, focuses on technology, healthcare, FMCG, and digital banking. If you look at where these countries today in the cycle, I think from a valuation perspective in the US, you see all-time highs in valuation. On the MSCI EM, you even saw all-time high this year. But these countries, though Cubs specifically, are somewhere between 30 to 50% of their historical highs. So what I think this underscores is that the lack of foreign participation or the exit of foreign investors has also affected valuations. And as part of that, that's also had an impact on where these companies and where these markets are trading throughout the full cycle. I think the point to make on this slide, I think, is that the process is actually very important. And we can get to that point in a minute, is most ETFs you're aware of, they basically track an index. But the approach we take is very different. We take an active approach. That means that we actively manage a product. And we'll get to what that means in a minute. We are research driven. We are benchmark agnostic. We are thematically designed, and we are ultimately ESG compliant. This kind of gives you an idea of how can you get access to the Cubs countries, and again, the Cubs being Bangladesh, Indonesia, Pakistan, Philippines, and Vietnam. And what you see is that these 5 countries, despite their size, despite their growth outlook, despite their promising outlook, they're basically ignored in most indices. And this is partly a virtue of what countries are in individual indices, but also the way the indices are constructed. And historically, the indices are basically constructed using a market cap weighting approach, which means that the largest companies today are the largest weighted in the index. But what that potentially underweights is the opportunity for companies to grow going forward, or the opportunity for companies to return going forward. Just one point to make on this: if you look at the emerging frontier index, which is on the right, Yes, Bangladesh has a higher weighting in that, but the majority of that exposure is actually via nominal Bangladesh. If we get to the process, how do we get to our companies? The universe of companies across the Cubs is roughly 3,500 companies. And we basically use a two-step process to basically get to the portfolio, which we then apply through a systematic filter. Specifically, when we start with the 3,500 companies, we place 5 filters. The first filter is ESG, the second is size, the third is liquidity, the fourth is quality, and the fifth is risk. That, in our mind, then which is a quantitative filter, eliminates the majority of the companies in the universe. The next step is we do a bottom-up analysis, which basically goes into each of the 80 companies in detail. We know all these companies, they know us. That means every company in the portfolio we've met or we've spoken to. In the post-COVID world, we'll resume traveling. For now, it's frankly not possible to travel to these markets the way we used to. And what that means is that basically every company in the portfolio, we also have a good sense of who are the people behind the business. Because what we've realized historically, there's companies that screen well, but when you meet the operators or the stewards behind the business, you struggle to get comfort with the company or with the management. And what we like to say is we focus on both the jockey and the horse. The jockey being the management team and the horse being the business. In our mind, we want to marry good jockeys with good horses, and those are the kind of companies we want to invest behind. Specifically, in the other 2 points, financial analysis, what does that mean? Every company, we obviously, the top-down screens run on Bloomberg data, but we then corroborate what the Bloomberg data is based on filings. So for every company, for key income statement and balance sheet line items, we've gone through the last 10 years of filings, and we've basically taken those numbers from the filings, put them into Excel to ensure that they basically triangulate with what we've seen in Bloomberg, but that we're also fundamentally happy with what we're seeing from the filings, not just from Bloomberg. On valuation analysis, we don't have a strict cutoff, but what we do look to understand is where are these companies trading in the cycle. So we take an approach where we look at standard deviations, +2, -2, to understand where is this on a 10-year basis trading to get a sense of where we are in the cycle. I think one of the key questions to ask yourself are, what is your exposure to Bangladesh today? How do you get that exposure to Bangladesh, especially if you're living outside the US? My understanding is this webinar is focused on investors both in and outside the US. And I think the key thing to think about is the Cubs, the way we identify it, the theme is thematic investing in the fastest growing next billion people. Today, there's 860 million people across these 5 Cubs countries. But in our view, based on the World Bank data, there'll be 1 billion people in the next 15 years. We believe this is an untapped, remarkable opportunity. I think there's a few other things I'd like to add on this point before we get into the firm. And there's a report that came out this week from Facebook and Bain, and it's our annual Southeast Asia report. And one of the key takeaways from that report was that in 2021, Facebook and Bain expect by the end of this year, 80% of consumers in Southeast Asia will go digital. Now, that's a remarkable statistic. And if that actually happens, that would suggest that digital adoption in Southeast Asia is ahead of the US and ahead of China. I think the point to underscore is you have the combination of a few factors that lead to a very interesting opportunity, but an untapped opportunity. It's a combination of a large demographic. It's a combination of a young, digitally enabled population. There's also the combination of a number of companies that actually don't have access to foreign capital markets. So unlike China, India, and even parts of LATAM, which have a lot of ADRs, which allow US investors to buy them from their phone on nicely, that's not the way you can get access to the countries in the Cubs. So specifically around the Cubs, of the 3,500 companies, there's 2 companies that are listed in New York. And if those companies are stereo enterprises, which again are companies I tend to avoid. So the point is, if you want to get exposure to the Cubs, there's basically no way to get exposure. And there's no way to get exposure in the form of I offer. And specifically, if you look at what's out there today in terms of individual country ETFs, you basically buy legacy economies. And my view is you want to buy the economy of tomorrow. Just in terms of what is the team behind Dawn, so this kind of covers the key parts of the business, from investing to research to market distribution to ETF execution and market making. What we've done here is basically we've actually partnered with what we believe are the leading institutional grade parties in each of those fields. So that basically means that market making is done by the likes of Virtu, Goldman Sachs, Citadel, Jane Street. ETF execution is done by ETC, which is the largest and best ETF third-party issuer in the world. On the research side, we basically work with some of the leading research houses in the region. We also work with 3 analysts in the region who I've worked with for the last 5 years. They basically help me on the research side. And on the investing side, obviously, that's something that I've covered. I have an analyst who works for me as well. This kind of gives you an idea of the key philosophy behind Dawn, essentially, which is providing a novel, innovative approach to investing in what I call next-gen EM. This also gives you an idea of the people behind the organization. We're still looking to build the organization out. We actually have a community manager joining from Bangladesh next week, which is going to be our next hire. Maybe to close, I appreciate we only have a short amount of time. I thought I'd also just sum up where you can find information about Cubs. The ticker is CUBS Cubs. All the information is on dawnglobal.com. We've released a number of podcasts, webinars, presentations. We were very lucky to partake in a roadshow by the Bangladesh SEC in July of this year. I was featured on a talk together with Larry Summers and the chairman of the Bangladesh SEC, Professor Shibli. And I think what this again underscores that I think there's growing interest in Bangladesh. And as recently as 2 days ago, you may have read that the largest ever VC investment in Bangladesh was announced. This was a VC investment by leading US VC firms, including Sequoia Capital, Valar, and Prosus Ventures, which is part of Naspers. I think what this underscores is that there's increasing investor demand for Bangladesh. That's now also coming in on the private side. On the public side, there's no way to access that unless you want to try and go directly. For most investors, trying to go directly is prohibitive, given the issues they face with compliance, with custody, with account opening. And therefore, the Cubs ETF is their best way to basically get public exposure to what I believe are the best companies, liquid companies in Bangladesh today. With that, I pass it back over to Najor. I'm happy to go through any questions. Thank you so much for joining today. And happy to cover any new ones.
Thank you so much, Maurits. We'll take a few minutes for questions. Feel free to raise your hand if you have a burning question. Otherwise, I'll go through those in the chat. So the first one is Will from New York. How do you think about selecting securities, sectors, valuations, etc., and constructing a portfolio to ensure country economic growth translates to equity returns?
Sure. So the way we have it is basically we don't hedge. So we have there's 3,500. Well, specifically, how do we get to these 5 countries? Maybe take that step back. In the world, there's 193 countries. The first criteria we looked at countries that have 100 million plus people, which basically eliminates all but 15 countries in the world. The next criteria we looked at countries that have grown dollar GDP, nominal GDP, since 2000 at over 5%. And that basically reduces all that, of those 15 countries, reduces to 12 countries. Then we looked at countries that have had less than 5% FX depreciation a year since 2000. That reduces the list from 12 to 9. The 9 countries you're left with are the 4 BRICS and the 5 Cubs. That's how we basically get to these 5 countries specifically. In terms of how we basically build a portfolio, I think I showed you how the investment process works, which has a top-down quantitative screen and bottom-up qualitative element to it. The portfolio itself is equally weighted semi-annual rebalance, and it has country and industry concentration limits. The reason why it has these limits is to ensure that no company, no country, no industry can blow up the product. Historically, in our view, when countries when EM investors have lost money, often that's had something to do with the fact that they've been overexposed or overconcentrated on one industry, one company, one country. So, the bottom line is, we are very focused on risk. That's why we have this equal weighting, semi-annual rebalancing approach. We have a strict process to basically get to the companies, or to first get to the countries and then to get to the companies. I'm happy to go through any more detail if that doesn't answer your question.
Excellent. What assets under management do you have currently? What is the weighting of Bangladesh now? And is there a strategic target in the future? And what is the current investor base like, institutional or retail?
So currently what's the AUM right now is approaching $15 million. We've only launched 10 weeks ago. There's 2 quite material investors we're speaking to that coming into the product, which we'll hopefully announce at some point in the next 6 months. The weighting Bangladesh right now is 17%. There's no strategic target, there's a limit. So we have passive country limits at 30%. The investor base, again, is a combination of institutional and retail. We have started off obviously on the retail front, which is why we've done some webinars and podcasts, but we're speaking to a number of institutional parties, 2 of which I mentioned earlier. And these would be parties that would, I think, look to basically build their exposure to the region. They realize that they would like to have diversified exposure to the region. I think the lesson and the feedback we have from a lot of investors is, as much as they like a country like Bangladesh, they're still slightly reticent to basically go into single country products, which is why they like the combination of the 5 countries we've composed, given the regional similarities, but also given the fact that it's very hard to get exposure to these companies.
Are there any downsides in your view of the growing trend of emerging markets tech companies dual listing on the local stock exchange as well as the NYSE?
Yeah, so it's a very good question. I think the difference in the Cubs countries is there's very few NYSE listings. And the reason is that the regulators in these countries are focused on promoting domestic capital markets for global capital markets, which explains why the governments in these countries want companies list locally, because ultimately they want to attract foreign capital to these markets. The best latest example is actually in Indonesia. The 3rd largest e-commerce player in Indonesia, Bukalapak, IPO'd last month in Jakarta. That was a company that previously had been rumored to look at IPOing in New York Stock Exchange, but the reality is the regulators, but also the company realized that they actually wanted to basically grow their domestic investor base. And I think that also underscores that investors expecting to get exposure to these countries through NYSE listings are going to be waiting for a while, because regulators and companies are focused on local before global listings, which is why you've seen a flurry of local IPO activity in these markets that hasn't transcended into dual listings abroad. So I think the bottom line is this risk applies, but it doesn't actually apply to the Cubs countries. We've seen this risk apply quite prominently in China, to a lesser extent in LATAM, but also increasingly in India.
Got it. We'll keep going. So Shah from Dallas, he's got a few questions. So is the equity index hedged for foreign exchange? Second, how are you constructing filters for ESG? And how are you getting comfortable with the financial statements integrity?
Good questions. So on the first question on FX, we don't hedge FX. I think there's three reasons. One is, we've looked at hedging FX with the different partners, but the reality is hedging FX in these countries in duration, size, and on a cost-effective basis is very hard. The reality is that the FX curves in these countries are still not deep enough. At some point that may change. The way we basically manage that currency risk is by having diversification across the 5 countries with the strict limits. The thinking is that you basically can't wake up and one country can't be a big part of your portfolio. The second point on ESG. So for now, we have an ESG exclusion process. What that means is that we actually exclude certain companies by virtue of their industry. We're working towards an ESG inclusion process. What that means is that we're basically awaiting, we're working with Bloomberg, MSCI, and Sustainalytics to basically get ESG ratings for some of the companies in these countries. And once we have the ratings for these companies in these countries, then we can actually apply an ESG inclusion approach. But for now, it's exclusion based. And that means that we specifically exclude certain industries, including tobacco, fossil fuels, gambling, mining, and pornography. And then thirdly, on the financial statements. So again, this is a very good question. The way we get comfort is we basically also focus on companies getting a top 10 global auditor. Now, ideally, we get a top 4. The reality is that in most of these countries, top 4 is still a stretch. If you look at the portfolio, I think over 80% of the portfolio is audited by a top 10 global auditor. Now, that doesn't remove the risk that there could be audit issues, but I think there's 2 ways to try and mitigate it. One is by focusing on companies that have a certain quality of audit standard. And the 20% that are not top 10 audited, we're pushing them to basically move to a top 10 auditor. And the second thing we do is we basically also validate the financial statements based on what we see from Bloomberg. And we validate them independently, which is why we take key line items from the balance sheet and income statement, which we then diligence based on taking them from Excel to make from the filings into Excel to make sure we're comfortable with them.
Could you expand on the industries of tomorrow? What specific categories do you think are the most interesting to capitalize on the favorable macro trends?
Sure. So I think ultimately, technology is an overarching theme. The digitalization of these economies transcends just the technology sector, though. It applies to FMCG, it applies to healthcare, but also applies to banking. You see that in the rise of digital banking. I think a single example is, for example, in Indonesia. In Indonesia, the 2 largest brick-and-mortar banks in the country have a $100 billion market cap. Indonesia is the 4th largest smartphone market in the world, has a population age less than 30. And I think you can ask yourself, in Indonesia, a country like Indonesia, do you want to bank on the brick and mortar bank, or do you want to bank on the digital bank? So the 2 largest brick and mortar banks have a combined market cap of 100 billion. The one digital bank has a market cap of less than 15 billion. So my view is the industries of tomorrow are in all cases somewhat digitally enabled. But these are industries which I think also will benefit from increasing propensity to consume or propensity to spend by consumers in these countries. And ultimately, there is a strong influence of technology in the development of these different industries, banking being one, but also healthcare being another. I think in certain countries, even in Bangladesh, in my previous role at Kingsway, we looked at several technology-enabled healthcare companies in Bangladesh, especially on the diagnostic side. And I think what it shows is that the economies of tomorrow, in my mind, are not driven by more consumption of tobacco sticks or steel or cement. These factors may play a role, but I think the industries we want to be focused on are industries that cater to the growing young population. And these are industries which, again, I mentioned earlier, which are specifically healthcare, FMCG, digital banking, and TMT, technology, media, and telecom.
Going back to Shaf, can you comment on institutional investor appetite for the Cubs relative to the intense focus we've seen for India in the recent years?
Yeah, sure. And I think it's a very fair point. I think what's happened is that people basically focus on India, I think for a few reasons. One, because it's a big part of the index, and a lot of investors basically look at what's in the index and they track that. Two, I think it's a much better covered and much better known capital market story and also economic story. And I think three, people have historically had comfort with the fact that India as a single country is large enough and there's enough institutional Western players in these markets that gives people comfort. I think what that means is that people have kind of overlooked what I would say is the emerging next layer of next gen EM, and that covers countries which I'm focused on today. I think if you look at India specifically, it's straddled on one side by Pakistan, on the other side by Bangladesh. I think you could argue actually that from an equity returns perspective, it's actually been a much better place to be in a place like Pakistan than it has been to be in a place in India. Pakistan is the smallest part of our overall portfolio. It's roughly 8%. It's only focused on 4 companies. But the 4 companies we have in our Pakistan portfolio, the majority of their business actually comes from export businesses. So, for example, if you look at Systems, which is a software business we invested in Pakistan, 80% of its revenue comes from the US. So what is this? This is a business leveraging local talent, local cost base, but to a global market, which also means that the business is somewhat insulated from the FX risks you see in other products.
What are the biggest risks that you're focused on for a 10-year horizon?
I think there's a few risks. I think you have to worry about individual country risk, and that transcends from political risk to current account risk to foreign exchange risk. I think there's a risk that individually in these countries that there'll be periods of economic weakness. From a company level, I think the portfolio is geared to companies that are part of innovation or are looking to innovate. Therefore, I'm less worried about the companies in the portfolio. I think from a investor point of view, I think these companies or these countries, frankly, have been underinvested by foreign investors now for a while. I think there's a risk that foreign investors remain absent from these markets for a while. But my hope is that obviously as people look increasingly beyond China, but also the next layer of EM, and also I think investors in these markets realize there's an increasing amount of private capital coming into these markets, which is not matched by the same amount of public capital. Investors at some point will actually turn to these markets from the public side. I think an interesting analogy is there's a company in Southeast Asia called Sea Limited. Started off as a company out of Indonesia, is now a company that's global. It's the only company that historically was associated with Southeast Asia. It's now the largest market cap of Southeast Asia. It IPO'd in 2017 at a $5 billion market cap. It's now a $150 billion market cap. I think what that shows is there is actually demand for the region, but there's very few investable ways for people to get access to the region, given there's no ADRs, given there's no good ETFs, and given there's no other direct listings. So what that means, I think investors are crowded around Sea Limited. The reality that Sea Limited today earns more money in India than it does in Indonesia. So yes, it is a Southeast Asian company, but its Southeast Asian roots have frankly been surpassed by its global footprint.
How do you monitor portfolio companies on an ongoing basis? How much turnover do you expect in that portfolio? And with new capital, do you scale up current holdings as a default approach?
Yeah, so we have a we speak with every portfolio company every 6 months. We have a quarterly review. So the focus here is not on making lots of daily, weekly, monthly decisions. In my view, the quantity of decisions rarely leads to better decisions. So what we focus on is actually quality of decisions. So that means that we only make quarterly portfolio decisions. The 2 exceptions being if there's an M&A takeover event, we can act outside of our quarterly investment decision process. And if there's financial irregularity that comes up in a company, it has never come up so far, then we can also act outside the quarterly decision process. What that means specifically is we expect relatively little turnover on the portfolio. So we did an exercise where we looked at the back test, and we basically looked at if you were to look at the back test historically on the equal weighting semi-annual rebalancing, what would the annual portfolio turn be? And it was less than 15%, it was roughly 12%. With new capital, when it comes into the holdings on a daily basis, basically it gets allocated to the portfolio pro rata, what the allocation is at that time. Every 6 months, to be clear, we reweight back to equal weighting. If you look at the portfolio today, there may be one company that, or one product that kind of stands out. We actually invest in another ETF. I think it's just important to give a bit of context around that. In Vietnam, some of the best companies are foreign ownership restricted. What that means is there's a limit in terms of how much foreign shareholders can own in these specific companies. When that limit is full, the only way to buy into those companies is to pay a significant premium to foreign shareholders who are prepared to sell. We found a way around that is actually by investing in a locally listed ETF that focuses on these foreign ownership restricted companies. We, as in the ETF, swallow the cost of investing in that ETF, because for us, the focus is on giving the exposure to investors to the best companies in these countries, which is specifically why we've taken this route of actually giving exposure to what we deem the best companies that are otherwise inaccessible to foreign investors. If you were to buy a Vietnam ETF today, you don't get exposure to any of these foreign ownership restricted companies.
How do you deal with redemptions, especially during bad times? What are your strategies to deal with in these situations, especially if investments are in relatively illiquid stocks?
Yeah, it's a very good point, and it basically covers the point of liquidity. So for us, the reality, there's some companies I'd like to invest in, but I can't invest in because they're not liquid enough. And that's why liquidity and size are two key parts of the top-down quantitative screen. In my mind, we basically have to run ETFs and we have to provide daily liquidity. There's two things we've done around that. One is we basically brought together the best market makers, so Virtu, Citadel, Goldman Sachs, and Jane Street, to basically market make the product. In our mind, the more market makers, the higher quality market makers you have, the better you can control the spreads. And then the second thing we've also done is that we're focused on companies that have a minimum daily trading value. What that means is that, yes, if there are redemptions, we can manage that. The reality is that the portfolio is spread across over 40 positions, which means that even if there are redemptions on the individual stock level, our impact should be minimal. We've also stress tested the portfolio, looking at average daily trading value and also looking at free float market cap to kind of get a size of how big could the portfolio be, what kind of daily liquidity can a portfolio cater to. And for now, we're focused on managing that. We believe that we have a portfolio that's defensive, that even if there were to be redemptions, we can manage those quite carefully and quite easily. I think another point to add is in the ETF world, as you're probably aware of, a redemption at the ETF level doesn't actually lead to redemption on the underlying, given that units in ETF can be held. This is fundamentally different than a mutual fund. This is a structural advantage, both from a tax perspective and a liquidity perspective that ETFs offer. And therefore, while I don't deny the fact that liquidity is, of course, is a risk and liquidity is a concern, we're very focused on it, and it's also a core part of our investment process.
I think maybe this will be the last one, or next to last. But since you're actively managing the portfolio, what are you looking to outperform and over what period?
So it's it's a very fair question. So the starting premise of the product is that we're benchmark agnostic, and by benchmark agnostic, what that means is that we basically don't believe there's any benchmark to represent what we're trying to do. So the thinking there is because we are benchmark agnostic, we don't actually try to benchmark ourselves to another index. I think the indices that you could look at are the MSCI EM indices, but the reality is there's loads to no overlap with what we're trying to do. We believe we're a generally uncorrelated, differentiated product. And I think if you look at our performance in the 10, 11 weeks since inception, that's underscored. If you look at the key EM indices, they're down anywhere between 5 to 7%. As of yesterday's close, I believe our product was up roughly 8%. Now, it's too early to talk about performance, but I think what it does show is that we're uncorrelated relative to the big EM indices. And part of the reason for that is that we don't have the China exposure.
Excellent. Maybe we have time for one last question if anybody wants to put it forth. What is your assessment of the risk of what's happening in China relative to Bangladesh?
So I think it's frankly very different in terms of I think the Chinese risk is primarily driven by regulatory. Of course, there is regulatory risk in each of the individual Cubs countries. But I think the nature of the risk is very different. I think obviously foreign investors are much more prevalent in Chinese capital markets. I think the government in China is proven so far to be recently is proven to be quite involved in certain sectors specifically. My understanding, having also now worked with the Ministry of Finance and the Securities Exchange Commission in Bangladesh, is the government of Bangladesh is actually very receptive to having foreigners invest. And I think my view is that the government of Bangladesh is open for business, wants to attract more foreign capital, and if anything, the opportunity for Bangladesh is that people are looking to diversify beyond China, and Bangladesh is one of the least tapped of one of the fastest growing economies in the EM that people don't have exposure to. I noticed there's two other quick questions on expense ratios and large asset managers. So I think on the last point, I think what you see is that large asset managers for now are actually still not really focused on frontier markets. What you're starting to see is you're starting to see large private equity investment firms focused on these markets. On public markets, there's no BlackRock products that are focused on this. The closest product could be the iShares Frontier ETF, but I think the Bangladesh weighting in that is 5%. But overall, I think what you're starting to see is people warming up to the idea that these countries are investable, they're liquid, they're large, and they have unique demographic and digital characteristics that make people excited. On the expense ratio is 99 basis points, which is, frankly, you could argue is perhaps more expensive than you'd expect. But I think to give you a few reference points, on the passive ETFs that cover the region, for example, the Pakistan ETF, I think it charges 92 basis points. So what you're getting here is a fully baked, active product, which also gives you exposure to companies which others can't get exposure to, specifically, for example, in Vietnam. Or otherwise, if you were to buy the VanEck product, which I think charges roughly 70, 75, you basically buy legacy SOE industries, focus on what I would call the industries of tomorrow.
I guess we'll end with the call to action. So just want, if you can remind us one more time, how can someone start today as an investor in the ETF?
Sure. So you basically can buy it on like you buy any US listed stock. The ticker is Cubs, CUBS. And you can, just like you buy any other ETF or stock listed in the US, you can buy the Cubs ETF. It's traded daily, intraday, liquidity. I'll be doing more of these kind of, webinars and sessions. And frankly, if there's any questions you have, then feel free to reach out to me. I'll share my email right now in the chat so people can reach out to me directly. And I'll probably make this presentation available to investors through an email I'll send after this session.
Excellent, Maurits. Thank you so much for taking the time to speak to us, and all the best, and looking forward to speaking again soon.
Thanks so much for having me. It was real fun, and I look forward to staying in touch.